Hey everybody, it's Gav here from GCRE. Today we're speaking with Mauricio Roll from Premier Law Group. It's season 1, so we're doing episode 2 today, where it's going to be different types of syndication deals and the legal way to go about setting them up. This is a pretty interesting conversation that we're going to have today. Mauricio is going to speak probably for about 5-10 minutes tops, really, and then the rest of it will be me really asking him some questions, which I know a lot of you have been burning to ask as well. So without further ado, let's add Mauricio to the call. Mauricio, hi, how are you doing today?
Hey, Gavin, how you doing, man? Good to see you.
Yes, same here. So today we're going to talk, Mauricio, about the different types of syndication deals and the legal way to build them, or should we say to build them, but also to do them the legal way and actually developing them, I think is the way to go for it.
Yeah, it's been an interesting topic because there's obviously, or maybe not obviously, there's a lot of different ways people raise capital, right?
Yeah.
So the most common way I would say is what I would call a project-specific raise. In my world, it's usually real estate. So usually you identify a property, you get into contract for that property, and that could be a multifamily, it can be a commercial, it can be a hotel, like whatever. You identify the property, and now you say, okay, here's the game plan for this property. This is my acquisition cost. These are my value add expenses. Here's everything I need to do, my fees. And so I need to raise a certain amount of money to go purchase a property and to go execute on a very specific plan. In my world, in multifamily, most of the time, most of the time people are buying a property, they're putting some money into it to add some value, fix it up, add some units, do something to add value to the property, which then allows them to increase rents, allows them to increase occupancy, and then they either sell the property for a profit or they refinance and get some cash out. I mean, that's a basic project-specific raise, and that can be, doesn't have to be property, it could be with a hotel, it could be with a business, you could be a startup, but I have something concrete to look at as an investor, as a passive investor. I've got something really concrete. And so I'm actually looking at very specific numbers, for example. Like I know, how much it's going to cost to acquire the asset. I know how much money we need to put in. I know what the assumptions are on this particular property. And I can make my own, I can actually challenge your assumptions and say, hey, I don't think you're going to be able to raise occupancy to this number. I'm going to do it at a lower number, be more conservative. Or maybe you think you're going to be able to raise the rents to a certain number, and I don't think you're going to be able to do that. Or if you're a startup, maybe you think you're looking to raise $1 million to go do this thing, and I may think, I think it's going to take a little bit more than that. So you're going to have to raise more. I mean, there's all these assumptions I can make because I'm looking at a particular property, a particular asset. Okay, so that's the one that most people do. Now, you don't have to do it that way. What many people are doing, especially here in the United States, during the global pandemic, during COVID, in the early stages as well, there was this belief, and a lot of people still hold this, that they thought there was going to be a lot of opportunities that were coming up in the near future based on the whole COVID thing. And there was an expectation that prices would be coming down and people would be in trouble, and that they would literally wanted to put together an opportunity fund. Yeah. There lies the second type of structure that a lot of folks use, which is instead of identifying a property or an asset, I keep saying property because that's my world, but this applies to any startup, business, whatever. But when you identify an asset, then you raise the money for that asset, you can do it the flip side, which in theory sounds much better, and it is actually kind of better, easier anyway for the syndicator, which is you could first raise the capital first and then go find a deal, right? That typically it's less stressful for the syndicator because on the first way, when you're doing a project specific, you're under contract or you're about to acquire a business or something, there's a deadline. There's a price to go raise the money, and it's like it's a 30, 60, 90 days of stress to raise the capital. But when you're doing a fund, there's no pressure because you don't even have an asset. So in my world, people would raise capital and then have that capital sitting in their bank account ready to be deployed while they go out and look for a particular project, again, property or business. Once they find it, they don't have to go back and ask for permission. They would just deploy those funds. The main difference there is just the investor doesn't know what you're investing in. In the first one, you're giving them an idea, not an idea, you're actually showing them what the asset you're acquiring and all the numbers behind it. With a fund, which is what we call these are funds, you provide fund criterias. These are the types of properties I'm going to go buy. These are the types of markets I'm going to look at. Or if you're buying businesses, these are the types of businesses, the size of the business, like all these parameters that you put together.
So it's sort of like a mandate.
Yeah, it's mandated. We call it fund criteria or parameter.
Yeah.
And so the investor really is betting on you, the fund manager. I always say they're betting on the jockey as opposed to the horse, because they have no clue. I mean, they have an idea, but they don't know what you're going to buy, and they really are relying on your expertise, and they really have faith in the individual that they can take my money and then go find whatever they're telling me to go find, and then execute on a particular game plan. And I don't have the opportunity to look at where the property is located or the condition of the property, or I have no idea what your assumptions are, because there are no assumptions, right? So that's kind of the fund model, which a lot of people are really interested in. So that's another kind of type of syndication you could do. Then there's like a hybrid, which I call a portfolio raise. So in a project deal, you raise money for a particular asset. On a fund, you basically raise money on an idea. With a portfolio, you're just buying multiple assets. So some folks will say, hey, I'm raising X amount of dollars to go buy 20 single family homes, or 5 hotels, or 3 businesses, or it's more of a portfolio, which is really more, it's similar to the project specific, because even though I have a lot more assets, I know exactly, I've identified the properties, and you're going to be giving me information on each of those assets and what the acquisition costs, what the game plan is for each one. And so that's kind of like your hybrid model. And then the last one I think that people are using in my world quite a bit is what we call a fund of funds model, which is where it's a fund. So, well, it's actually between those three, it's probably closer to a project specific, because they're actually raising money not to acquire an asset specifically, not a property or a business or something, but they're raising the capital to go invest in somebody else's fund. Somebody else, for example, may have a huge project. Maybe you're used to doing $2 or $3 million raises, and this project is a $20 million raise, for example. It's a $100 million project or whatever, and you need a large amount of money. And so instead of taking that, well, first of all, you're not the one doing it. Somebody else is raising 20 million. You can go out there and raise a little piece of that, right? So maybe you go raise 2, 3, 4, 5 million with the intent of basically taking that money and investing it as a limited partner, as a passive investor into somebody else's fund. That's something that we call a fund of funds. And there's a little bit more nuances on that. It gets a little bit more complicated, especially here in the US, because when you do that, you now leave the realm of investing in real estate or investing in a business or something like that. Now you're actually investing in securities, because you're actually buying shares in a different company. These are LLC units or LP units usually, but you're, as you can see, you're buying kind of shares in a corporation or membership units in an LLC or limited partnership units. And so you are now buying, and you're actually raising money to acquire a security, which makes you an investment advisor. That's the big wrinkle to the whole fund of funds. So that now becomes, here in the United States, every state has their different rules, and so we have to make sure we're following each of those rules. Some of them may require registration, some may have exemptions, and so that kind of adds a little bit. But I think those 4, from a structural standpoint, I may throw in, if it's a really small deal, sometimes people just kind of do promissory notes. I mean, that's maybe another type of equity raise that people would do. You know, if you're buying a small single family home and you're going to rehab it and you need $20,000 or $50,000, you know, Gavin may come up and loan me the money, and I just, you know, give you a promissory note, and ideally I would secure it with the property, and then I move on. But that's small more on the smaller scale. But I think those are kind of the most common ways people would raise money. And by the way, none of those have any bearing on the securities compliance piece. All the rules that we talked about in episode 1 regarding raising capital and complying with federal law and complying with state law, or if you're doing international stuff, you know, the Reg S, the same rules apply. The raising of the capital is the same. You've got to comply with all those rules. It's just, what are you doing with that capital once you've raised it? That's really what's different. In one scenario, I have a particular asset I'm buying. On another one, I'm holding onto the money and waiting. On another one, I'm buying a portfolio. On another one, I'm buying another fund. But the actual act of raising the capital, that's your securities offering. That doesn't change from a compliance standpoint.
Okay, sounds really good. Thanks for that. No, that's actually pretty clear for me, because, you know, it really lays it out exactly what the different types and the different models are. So, for example, I think when I was in Texas, I saw a lot of people probably done the promissory note. side of it, because there's a lot of people who are flipping houses in the state of Texas and Florida and New York, California. Really, where I actually didn't know about was a hybrid portfolio model. I'd never heard about that. Is that something that's relatively new, or is that
it comes up when you're buying low denominated assets, single family homes, for example. If you want to buy a single family home that costs $100,000, the compliance cost of putting a syndication together for $100,000 doesn't make sense. The economics don't make sense. You're going to be spending 15% or something on compliance costs. That doesn't make any sense. So what people typically do when they're doing that is say, well, $100,000 doesn't make sense, but if I buy 10 of them, now I'm raising $1 million as opposed to 100,000, and there now the economy start making sense because it's the same compliance cost whether I raise $1 or I raise $1 million or I raise $100 million. Usually the compliance cost is very similar. So that's when the specific portfolio raise comes into place, is when they have a great idea. It's just kind of small and they want to scale it. Nobody's going to get rich off buying $60,000 or $100,000 homes.
No.
But 20 of them or 50 of them or 100 of them, it starts to make sense. And that's where the portfolio raise typically kicks in.
Yeah. And then I guess let's just touch on the opportunity fund for a minute. So these are funds where people actually raise the money. So you said it's kind of the model where they don't go and look for the property first, because then they're on a timeline to actually hit the deadline. This kind of probably would be the best way I would see somebody who's smart would be investing in. So raise the finance first. That way, if you can't raise it, then you haven't lost anything. And then you go and so would you say it's safe to raise the money first before you comply and incorporate and get all the regulatory requirements? Or do you have to do the regulatory requirements first?
You have to comply at the time you start accepting funds, which is when you're actually selling the security. When you provide them, when they give you money, and in exchange for that money, you're giving them a piece of the LLC or a piece of the entity. That's the security that's being sold. So because you're just raising the capital and it all ends up in a bank account for the next 2 or 3 months, doesn't mean you haven't been selling securities. You have been. So you have to comply with securities laws, spend the money to incorporate your business. And again, if it's real estate, it's probably here in the US, a limited liability company, comply with all the federal and state securities laws, raise the capital legally, file all your forms. And then the only difference is when you close your offering, instead of going and actually acquiring the property or the asset at that point, you don't have anything. So you just have a pile of money sitting on it. It's absolutely the most ideal way of doing it in theory. It's just much harder to do because the investor is literally, you have to have a really good track record and the trust of the investors implicitly that they're willing to hand over money to you and then trust you that you know what to do with it, as opposed to a project specific. As the investor, yes, I obviously need to make sure the syndicator can execute the game plan, but I'm actually looking at the asset and I can challenge the sponsor's assumptions in my own head. I can look at the pro forma, the projections, and I can adjust those assumptions to make it more conservative or make it like I've got some wiggle room. And so, yes, it sounds like it's a great idea, and it is, although there are some wrinkles, which we should probably talk about in a sec. But it's much harder, in my experience, to raise capital first. Most investors prefer to actually know what you're investing in so that they feel comfortable, handing over the cash. Now, it does create some issues too. Like, for example, I mean, the most common, most obvious one is probably, if you go raise, let's just call it $2 million into your fund, and now you've got $2 million sitting in your bank account, and you can't find an asset to acquire, and it sits there for 2 months, 3 months, 6 months. I mean, how long is it going to sit there? It's obviously not generating a return. So do the investors really want to give you $100,000 or $200,000 so that it sits in a bank account for 6 months and doesn't earn any return? The opportunity cost there is high. So we've got to compensate for that, and we come up with certain structures that kind of mitigate that risk. And I'm happy to talk about some of those ideas that we've implemented over the last couple of years in terms of trying to mitigate that issue.
Yes. So just for the audience understanding, there's two things. You talked about limited partners, or I kind of have an idea what that is. So there's two types of investors. There's the institutional investors, and then there's the accredited investors. Can you just elaborate a little bit of the big difference between those two of them?
Yeah, and there's really the third, which is the non-accredited. So most syndicators who are either just starting out, or I would probably say most syndicators who are the sort of like you and me who who either do this as in addition to their regular jobs, or they've kind of a smaller scale. When I say small, $1 million, $2 million, $5 million raises, not $100 million raises. Typically, they are offering these investments to either accredited investors or non-accredited investors that are sophisticated. And sometimes you're allowed to accept non-accredited, sometimes you're not. An institutional investor is what the name implies. It's actually it's an institution. It's a company that is in the business of investing assets. So a private equity group or a family office or maybe a pension fund that has these large amounts of money that they need to go place. They're typically not, your mom, what we call mom and pop, where you're individuals, and we're trying to figure out if this individual is an accredited investor or a sophisticated investor. We're talking about a big company or corporation that may be in the business. A private equity group would be something that's specifically looking to invest.
Yes.
But, all of these pension funds, teachers union funds. I mean, all these companies that have, even all these pension funds, companies that they got to do something with that money.
Yes.
And the yields these days are so low. In the old days, maybe they put the money in a certificate of deposit, a CD, and we're happy earning 5% or something, and they call it a day. Obviously, we're not getting 5% on CDs. In many countries, our rates are negative, and so they go look and place their money in a little bit, as we say, further out on the risk curve. And so they're investing in these private placements, and that's what an institutional investor is doing. Supposedly they're more sophisticated, but as we found out in 2008, that's not necessarily true.
Well, it's always like that. I am actually having some conversations with some institutional investors in the coming weeks. I'll let you know how that goes. But definitely.
And there are a lot more. I'm not sure this is the right word. I would say finicky, but they're a lot more demanding. Typically, when your investors are individuals, and they're even if they're accredited investors that are investing 100,000, 200,000, even 500,000, you typically put the structure together and you present it to the investors, and it's a take it or leave it. Or maybe this is another structural thing, but it's a take it or leave it deal. You're not negotiating with an accredited investor who's going to invest 100,000 if they don't like the way you structured it or they don't like the returns. That's not something you're going to be negotiating with them or changing. It's going to be, here's the deal. You can either invest or you don't invest. It's that simple. With institutional money, because they're coming in traditionally with a large amount of money, they may be coming in with all of the money, or if not all the money, 80% of it, or a really high percentage of it. There is a couple of things that differentiate it with an accredited. Number one, you're going to be negotiating with them. They're going to be putting their terms on you, and here's what I'm looking for in exchange for giving you the money. And then you can push back, and you guys, there's some negotiation going on. And number two, they're often, not typically, but often will want a lot more control, not in the day-to-day operations, but certainly major decisions, or they may have some override or some veto powers, maybe approving budgets or something. So they're going to be a little bit more involved than the take it or leave it accredited investor. Even if that accredited investor is putting in a larger amount, even $1 million, it's a take it or leave it situation. Institutionals, you're going to be negotiating, and they're going to have very specific terms and fees. A lot of the institutional firms are also broker dealers, so they can actually accept they can accept fees for placing the money into your deal, which ordinarily you wouldn't be able to do. So, but yes, that's definitely an attractive model if you can get it.
Cool. So, in regards to sort of the different how you said the certification that you need from the SEC to comply with these sort of, let's say the first four, are they all the same, or would it be different for each one?
They're all the same. So we always start with the assumption that if you're selling a security, which in this case, in all of those deals you're exchanging a percentage of the company in exchange for whatever capital contribution you're making. That's the security that you're selling, and they're paying you for your selling. We have to register that security with the SEC, our Securities and Exchange Commission, or we have to find an exemption to that registration, or it's illegal. Those are my famous the three that I like to do.
Yes.
So same thing. We're going to look for an exemption. We're not going to register it. We're not going to do anything illegal. We're going to find an exemption. And what exemption we pick will depend on who your investors are. If they're institutional investors, most likely they're all going to be accredited. It'll be a 506B or a 506C. But that part doesn't change at all, and it's still a securities raise.
So does that differ from institutional investors to accredited investors, or is it still the same?
I mean, the only again, if you have an institutional investor, we're doing this right now. If you have an institutional investor who's relatively passive, they're just writing you a big check, then that's most likely going to be a security.
Yeah.
Especially if there's other investors involved as well, then that's going to be a security. If it's just one investor, which is the institutional investor, and they're relatively actively involved, maybe they're not day to day, but they've got a lot of say and a lot of input, that likely puts them into the category of being more of an active participant. And so now it's more of a joint venture as opposed to a securities offering, because both parties are actively involved in this deal together. Now, that doesn't mean that there aren't best practices. I mean, typically, if you're doing a fund, I would say, and again, let me just backtrack a little bit, because I know we talked about this accredited and institutional. I would say most raises, I'm not going to say I know that most raises only involve at least accredited investors. There are not many offerings that involve non-accredited. It's actually, the last data I saw is about 10% of the offerings involve non-accredited. It just so happens that in my world, that number is skewed. So in my world, I would say probably 60% of the offerings I do have non-accredited investors, just real estate. But typically, if you're doing a fund, because it's a little bit more blind, it's a blind offering or a blind pool fund. It may be best practice to limit yourself to accredited investors only, because that kind of limits your risk a little bit, because you're raising capital without knowing what you're going to be buying, and once you buy something, the investors may not be happy with you, and there might be some issues. So having accredited only protects you a little bit more. But if you wanted to have non-accredited, I mean, I've done plenty of funds that have non-accredited investors. We just need to make sure we're complying with all the rules and giving them the full level of disclosure document, making sure they understand what they're getting into.
Okay, and in regards to timeline for registering these different opportunities, does the timeline differ for each one, or is it pretty much across the board still a straight?
The timeline is not a legal timeline. So clearly, if you're doing a project specific deal, you've got a timeline because you have a closing date. So once you get into contract to purchase an asset, again, real estate or business or what have you, you've got to close in 90 days or 60 days or 100. So there's a clock ticking, but it's not on the security side. It's just you've got to actually get everything, all your ducks in a row. You've got to raise the capital and be ready to close in 90 days or 120 days or whatever it may be. With a fund, there is no deadline, right? There, in theory, which is actually a good thing and a bad thing, right? So there's no deadline, right? Because you don't have anything. At this point, you have an idea, you have a game plan, you've got something to present, but there's nothing out there. You're going to wait to raise the money first, then you're going to go execute on the plan. So that's a double-edged sword. On the one hand, people are like, oh, there's no pressure, there's no stress because there's no deadline. And on the other hand, there's no deadline and there's no stress, and so people tend to sort of drag that on. So in my experience, I mean, I can't tell you how many deals we started back in April and May at the beginning of this COVID thing that we kind of got it going, and then nothing's happened because there's no pressure, right? There's no pressure to actually do anything, and I don't even raise money. So that pressure is, people don't like it because they've got to get the money raised, but it also forces them to get things done. Otherwise, these things can just drag on for months or sometimes years because there's just no pressure.
And the registration with SEC, to go through that whole compliance program with them and filling out of the forms and submitting it and stuff, is that a lengthy process, or is that a straightforward process?
So it depends. So again, most of our deals, in fact, 99% of our deals, we don't register it with the SEC. We rely on one of the exemptions. And when you rely on an exemption, there is no registration process. It's all private. There are some forms we have to file after we sell the security. We've got to file what's called a Form D with the SEC within 15 days of our first sale. But that's just a notice filing. It's just check the box in 5 minutes. There are some, which is technically an exemption, which we haven't really talked about, which is a Regulation A, a Reg A exempt offering, which does require, we call it kind of a mini registration or a mini IPO, because there is a registration process where you submit your paperwork, your documents to the SEC, and then you work with the lawyers to kind of amend it a little bit or tweak it or just get it right so that the SEC approves it. That can take about 6 months. That's about a 6 to 9 month process. That's why a lot of people don't do it, especially in real estate when you have to close in 90 days or 120 days. You don't have 6 to 9 months to get this done. But if you're doing a fund that has no deadline, that's something that you could consider a Reg A offering, which is much more expensive than a Reg D because you're dealing with the lawyers. But on the other hand, once you do get it done, there's some great benefits. And then a registration, a registered offering, which is really going public. I mean, that's going to take you 12, 18 months, and it's going to cost you a lot of money, 6 to 7 figures, which is why I certainly don't deal in public offerings. But all those companies that go public, it can take 12 to 18 months, even on a small, if you wanted to put together a little real estate fund or something, and I don't know why you would register it, but if you wanted to, it'd probably take you about 12 to 18 months to get it through the process.
So it can be a lengthy process then if you want to go the full way.
That's why we always use. That's why there's no reason. There's very few reasons to do a registered offering. I mean, unless you're really big time and you're going to go raise $1 billion or just a really huge amount of money. With the way the rules have been amended over the past several years, and you've seen this actually in the amount of IPOs, the registrations have gone way down and the public offerings have gone up, because one of the big limitations in the old days, and by the old days I mean 5 years ago, is that you could only have a certain amount of investors in your deal before you had to go public. I think it was 500 investors or something. So
something like that, yeah.
Like a Facebook or something that wants to keep doing this privately, which is great. So they do Series A, Series B, round A, second round, third round, fourth round. At some point, you get butt up to that 500 investor limit. You have to go public, which is what used to happen. They extended that to 2,000 investors. So now you can have 2,000 or maybe 1,999 investors and still be considered a private company. And so, yes, there's some advantages to go public, which is primarily liquidity and access to capital. But most, at least in our world, most will go with there's no reason to publicly do it. They do with the private offering, and at best, do a Reg A, which is a mini registration that'll take you 6 months. Okay,
and what's the cost usually? Like we're doing a Reg A income, like just an average ballpark.
Yeah, Reg A is probably in that $75,000 range. Plus, you've got reports, the annual reports and quarterly reports and semi-annual reports and entry reports and extra reporting. It's not as onerous as your public company reporting, but there's definitely a reporting component to it. As opposed to a Reg D, that's usually in the $15,000 range, and so it's a good 5 times more expensive, if not more, to do a Reg A than to do a Reg D. It's got a lot less regulation.
Yeah. Okay, cool. No, thanks a lot for that today, Mauricio. It's always a pleasure. I think definitely the viewers at home who's going to be looking at this, who is actually in that category of people who are just now starting off or who's looking to go out on their own, is literally, there is the project support raise, then the opportunity fund and the hybrid, and then the fund to fund models. I'm sure we'll touch on these as we go along with the different episodes. But do you have any last words or advice for people when looking at the fund side of it?
No, I mean, I think the only advice would be I would advise people to start small, just because for a couple of reasons. One, obviously it's a lot easier to raise a small amount of money than a large amount of money, but then you have a track record, right? Then from a marketing standpoint, you can go back and say, hey, this is fund number 2 or fund number 3, and you can point to sort of your success from the first thing. So a lot of people want to start with like this huge $100 million fund. When I say, why don't you do a $5 million fund, get that proof of concept done, and then the next one could be 20 million and the next one might be 50, and kind of stagger it that way so that you can have that proof of concept when you're going to market.
So the one question I do have for you, and it slipped my mind earlier, when you raise money for a fund, now obviously in the mandate, when you do this, you could say on your mandate what the money is going to be used for. Can you use the funds for multiple things in a fund, or do you have to raise a separate fund for separate things?
No, you can definitely legally, you can raise, the fund can be for anything. I mean, it's literally a blind fund. So your criteria could be, I'm going to invest in hotels and multifamily and self-storage, or I'm going to invest in real estate and a startup, whatever.
Yeah.
So from a legal perspective, it's fine. What I caution clients who want to do something like that is you want to make sure that the risk profile is somewhat similar, because even though there may not be any legal prohibition, an investor may be interested in your multifamily assets because they like multifamily, but you also are going to invest in mobile home parks, and they don't know anything about mobile home parks, and so they may consider those riskier. They may not understand, and especially when you're doing completely different asset classes like real estate and a startup, tech startup. Well, I may be comfortable with real estate, but I don't want to. They're just completely different risk profiles.
Yes.
That's when I would typically segregate them. But I've done plenty of funds that have multiple asset classes within them, and sometimes we even give sort of an asset allocation between those different asset classes. So we can absolutely do that.
Now, someone asked a question, so I just thought I would ask it. It made a lot of sense, because you do find some people, of course, the world that we work in is always real estate. But as you said, one might be industrial, one might be mobile home park. Because mobile home parks is up and coming, and everybody's kind of jumping on that right now.
Yep.
So they were just asking that question.
It's just a different profile. The same thing with a development. If somebody needs cash flow and that's what they want, and you have some of it is, again, multifamily, and then some of it is a development deal. Well, the development deal is not going to throw off any cash for the next 18 to 24 months. That's not but I like, so it's but yes, but you can absolutely do that.
Okay, cool. So Mauricio, how do anybody get in contact with you if they would like to touch base with you going forward?
If they go to it's a couple ways. Let's do a couple things. PremierLawGroup.net is the website. There's a little consultation button that you can find me. And I'm always going to offer my 5 things that every syndicator must know to stay out of jail. And you can get that by emailing me at jail@PremierLawGroup.net, jail@PremierLawGroup.net. That also will come to me. So if you've got a question, just email it through that email, but at least you'll get the book that I wrote that kind of lays out the basics. It's Syndication 101, essentially.
Yes. Okay, cool. Well, Mauricio, it was nice having you on the show again. And I look forward to seeing you next week, and hope you have a wonderful rest of the day.
Thanks, Gavin.
California.
Good to be with you. Thanks.
Take care. Ciao. Bye.